All right, let's dive right into this. Welcome to today's Explainer, where we're putting Universal Health Services, or UHS, squarely on the examination table. We're going to run a comprehensive Buffett-style financial health checkup using cold, hard data. If you're a strict value investor, constantly hunting for a margin of safety and a durable competitive advantage, well, you are in the right place. We're stripping away the market noise and looking purely at the fundamentals to see what the numbers actually tell us. So, the multi-million-dollar question is this: is UH a hidden gem that Mr. Market is massively undervaluing right now, or are we staring at a classic value trap? That's what we need to figure out today. We're going to examine everything from top-line predictability down to the intrinsic value to see if the data proves this is an absolute bargain waiting to be scooped up or a structurally risky bet that we should probably just avoid. Okay, Section 1, Taking the Vitals, Price and Performance. To establish the stock's current pulse, let's start with a quick snapshot. USS last closed at $171.01. But here's the kicker. That is down over 30% from its 52-week high of $246 and change. When a stock takes a haircut of nearly a third of its value, our value investing instincts naturally kick in. It usually means the underlying business is either fundamentally broken or Mr. Market is having a mood swing and it's heavily on sale. And when we look at the year-to-date return, we're seeing a sharp decline of almost negative 21.5%. The broader market pessimism surrounding this stock is totally undeniable right now. But you know the classic Benjamin Graham quote, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." So are the sellers simply overreacting to short-term noise? Well, what's really fascinating here is the price-to-earnings ratio. It sits at an incredibly low 7.39. Just to put that into perspective, that's roughly 37% below its own 5-year historical average. It's trading at a massive discount right now. For anyone with a rigorous value investing mindset, seeing an established, predictable business trading at a single-digit PE ratio, yeah, that definitely sparks some serious curiosity. Moving on to Section 2, Growth and Cash Flow, Evaluating the Diet and Exercise. As we know, a cheap stock is only a bargain if the underlying business isn't actively deteriorating. So we've got to look at how the actual business is growing. And this top line brilliantly illustrates why this company is so interesting to evaluate. The revenue compound annual growth rate is incredibly steady. Over the trailing 12 months, 3 years, and 5 years, revenue growth is locked in right around 8%. It's highly predictable. But then, look at the earnings per share growth. The 5-year average is a solid 14.5%, but over the last 3 years and trailing 12 months, EPS growth has absolutely exploded past 40%. Management is squeezing some massive earnings out of that steady revenue stream. But hold on, we really need to pump the brakes for a second. Despite those booming accounting earnings, we've got a major red flag flashing on the dashboard. The trailing 12-month free cash flow growth is sitting at negative 19.61%. So while net income on the income statement is soaring, the actual owner earnings, the free cash left over after maintaining the business, is severely contracting recently. And as seasoned investors know, earnings are an opinion, but cash is a fact. We absolutely have to keep this divergence in mind. Let's move into Section 3, Operational Efficiency, the blood pressure. To see exactly how well management is deploying their capital, which is arguably the most crucial check for any long-term investor, we're comparing two vital efficiency metrics. The return on equity looks fantastic, sitting at nearly 20%. That means for every dollar of shareholder equity, they're generating almost 20 cents in profit. However, when we evaluate the return on invested capital, which factors in the debt they use to generate those returns, it sits at a solid, though noticeably lower, 11.63%. It's definitely respectable, but it shows that leverage is doing a good bit of the heavy lifting for that high ROE. But watching how this builds over time reveals exactly what you want to see when assessing a competitive moat. The 5-year average ROIC was 9.32%. The 3-year average bumped up to 9.61%, and the current ROIC is up to that 11.63%. This upward staircase is a beautiful thing. It proves that management is getting increasingly efficient with their capital allocation over time. They're squeezing a better return out of every single dollar they plow back into the business. And that operational efficiency shows up directly on the bottom line. The net profit margin is currently 8.07%. Now, we all know that in the healthcare space, margins can be notoriously tight. But the crucial point here is that this 8.07% is actually beating its own 3-year and 5-year historical averages by over 25%. So they're getting leaner, and they are definitely getting more profitable. All right. Section 4, Debt and Dividends, Overall Stamina. To ensure this business isn't overly leveraged and carrying too much structural risk, we look right off the bat at the debt-to-equity ratio. It comes in at a very reasonable 0.63. In a capital-intensive industry like healthcare, which often requires heavy spending for facilities and equipment, having substantially less debt than equity is a really healthy sign. This number should definitely comfort the conservative value investors out there. This company is absolutely not drowning in debt. Zooming in on short-term liquidity, we see the current ratio is at 1.08 and the quick ratio is at 1.01. So what does this actually tell us? Well, because these numbers are hovering right around 1.0, it means the company has just enough liquid assets to cover its immediate current liabilities. They can definitely meet their short-term obligations, which is great, but there isn't some massive excess cash buffer just sitting around. They run a very tight ship. Now, what about rewarding the owners with cash? If you're purely an income investor, you might be totally uninspired by the tiny dividend yield of just 0.47%. However, look at the payout ratio. It's an incredibly low 3.37%. That means UHS is retaining over 96% of its earnings. They aren't paying it out in dividends because they're choosing to aggressively reinvest those earnings back into the business. And honestly, as a value investor, if management can reinvest that cash at the rising return on invested capital we saw a minute ago, keeping the money in-house is exactly what we want them to do. Which brings us to Section 5, Valuation and Prognosis, the final diagnosis. We've gathered all the symptoms and checked the vitals. Now it's time to bring all this data together to determine what this stock is actually worth. Let's start with a favorite metric for growth at a reasonable price investors, the PEG ratio. This factors in how fast the earnings are growing compared to the stock price. Legendary investors like Peter Lynch famously loved this metric. A PEG of 1.0 is generally considered fair value. Universal Health Services sits at a staggering 0.25. This exceptionally low score heavily signals that the stock is insanely cheap relative to its massive recent earnings growth. And honestly, the historical discounts are everywhere you look. The enterprise value to EBITDA is just 5.45. That's sitting over 25% below its own 5-year average. Whether you look at that low single-digit PE ratio we saw earlier, a price-to-sales ratio of just 0.60, or this EV/EBITDA metric, UHS is trading at a steep historical discount across virtually every single traditional multiple. But here is where the ultimate truth comes out. Let's look at the discounted cash flow valuation, the holy grail of intrinsic value for true fundamental investors. Step 1, the current price is $171.01. Step 2, the calculated DCF fair value is $174.77. That brings us to Step 3, the margin of safety. Despite all those incredibly low valuation multiples we just looked at, the fair value calculation, based purely on cash flows, only leaves a razor-thin 2.15% margin of safety. Remember that contracting free cash flow we highlighted earlier? Yeah, this is exactly where it comes back to bite the final valuation. So, I'll leave you with this to ponder. Is a 2.15% margin of safety enough for you to pull the trigger on an investment? You really have to weigh the incredible EPS growth, the rising operational efficiency, and the basement-level trading multiples against that recent negative free cash flow trend and a very, very tight intrinsic value cushion. The numbers are all out on the table. The final diagnosis? Well, that's up to you. Thanks for joining me on this explainer. And remember, always keep digging into the data.